Well, it is another Friday, September 12th. The market update desk, Scott Riley, NMLS 157524. Want to go over some of the more information that we broke down from yesterday's CPI report, go in depth on that, talk about the unemployment numbers that hit yesterday, and the other information coming in today, prepping for next week. So, yesterday we got that CPI report. Overall, the headline CPI price consumer price index rose 0.4%, which was a tenth hotter than what the market thought. But year over year inflation stayed in line with the estimates at 2.9%. Now, one of the headline contributors that caused inflation to come in hotter was energy prices. Now, those rose 0.7% in the month, with gasoline alone going up almost 2%. Now, since then, obviously, it's come down as I filled up this morning at 2.79 a gallon. Nice surprise there. The core rate of CPI, which strips out volatile food and energy, also increased 0.3%, but that was in line with estimates. And year over year came in right where the market expected at 3.1%. Now, when we break down these numbers, one specific thing jumps at us again: shelter costs. Now, shelter accounted for 56% of the total inflation, rising 0.44% last month. The biggest culprit, again, was owner's equivalent rent, or OER. Now, that rose 0.4 and made up one third of the total report. Now, it's amazing that within this number, in this analysis, OER, which is complete guesswork, by the way, it's not factual based, it's not data based, is such a huge weighting within the overall report. It's just too heavy of a weighting. Lodging away from home rose 2.29% and added 4/100ths to the report, but that figure is a wild card and has helped us in some of the reports in the past. Airline fares rose almost 6% last month and added 0.6 to the overall inflation. Used cars and trucks jumped 1% last month and added 0.3 to the report. Now, when stripping out shelter, airline fares, and used cars and trucks, everything else in the core reading was a very tame 0.06%. It just shows you when you get into the non-headline numbers and start to understand the volatility within this breakdown, and the fact that the majority of it's not data dependent on where we're actually at. Now, the core 3-month run rate jumped up from 2.7 to 3.6. The 6-month went from 2.4 to 2.6. The headline rate was the 3-month run rate jumped up from 2.3 to 3.5, and the 6-month rose, looks like 1.9 to 2.2. Now, the big news yesterday was the weekly jobless claims report. Initial claims rose 27,000 to a whopping 260,000. That's 30,000 more than the market expected. In fact, it's the highest level in 4 years. Now, for us in the mortgage world, it did actually help the bond market because it responded very favorably. Now, the report could be a turning point or an inflection point. We're going to continue to watch it. It could be showing that workers are finally starting to be let go, and that's adding more pressure in the labor market. Continuing claims remain steady at 1.94 million. In other news we saw this week, something that I didn't see, unfortunately, Oracle stock jumped a mind-blowing 330% this week. Fantastic return on investment if you're able to grab it. Next week, Fed report's going to be very interesting as we get some insight into the second part of their dual mandate, which is, of course, maximum employment. What's Fed Chair Powell's comments going to be about this portion of the mandate? Because in the past, he's always said, we have a strong labor market. We found that we've always said on this show that that's not the case, but the QCEW, the jobless report, that all shows that that was never the case, and they hung their hat on that. And that's why they're behind the curve in dropping rates. In fact, the ECB today held rates at 2%. Now, What was unexpected was their growth rate was revised up from 0.9% to 1.2%. So that was a little bit more strength in the ECB market than what was thought. Um, for us, the 10-year Treasury tested that all important 4% even mark. We got there, but then bounced up, and we're sitting, as I'm looking now, 4.07. This is all waiting to see what the commentary is going to be next week from Chairman Powell with the Fed meeting. We'll stay on top of it, get the information out to you. Refinancing, I just did one 15 minutes ago, saving a customer money. Uh, we are getting in contact with our clients, prepping them for potential money savings. The time's now to try to strike that iron while it's hot. Last year, when we talked to people, they had an opportunity to get 5.75%. The high to mid fives, and a bunch of people thought that the rates were going to go in the low fives, and they went the opposite all the way up to 7%. Don't be the one that doesn't seize the moment and saves money. Give us a call. We're on actually on call all weekend this weekend again. 616-293-2189. The Market Update Desk, your original singular market news source. Have a great afternoon, everyone.